Hi, this is a YouTube channel to teach manufacturing excellence through video. Today's topic is inventory management. How to control inventory. Controlling inventory involves a few key steps. 1. Inventory management system. Implementing an inventory management system to track inventory levels, reorder points, and sales data. 2. Forecasting and planning. Use historical data and demand forecasting techniques to predict future inventory needs accurately. 3. Regular audits. Conduct regular audits to ensure accuracy and identify discrepancies between recorded inventory and actual stock levels. 4. Set reorder points. Determine minimum inventory levels in reorder points to avoid stockouts while minimizing excess inventory. 5. Supplier relationships. Maintain good relationships with suppliers to ensure timely deliveries and negotiate favorable terms. 6. ABC analysis. Classify inventory items based on their importance and manage them accordingly. 7. Technology integration. Utilize technologies such as barcode scanning and automated inventory systems to streamline processes and reduce errors. How to take inventory. Taking inventory involves physically counting and recording the quantity of each item in stock. Here's how you can do it effectively. 1. Plan ahead. Schedule inventory counts during off-peak hours to minimize disruption to regular operations. 2. Organize. Arrange inventory in a logical order to facilitate counting and minimize errors. 3. Use a checklist. Create a checklist of all items to be counted to ensure nothing is missed. 4. Count methodically. Assign specific areas or sections to different team members to count systematically. 5. Verify accuracy. Double-check counts for accuracy, especially for high-value or fast-moving items. 6. Record data. Use inventory management software or manual recording methods to document the counts accurately. 7. Address discrepancies. Investigate any discrepancies between recorded counts and actual inventory levels immediately. 8. Analyze results. Use the inventory count data to identify trends, adjust reorder points, and improve inventory management processes. Consistency, accuracy, and attention to detail are key to successful inventory taking. How to close inventory. Closing inventory typically refers to the process of finalizing the inventory records at the end of a specific accounting period, such as a month, quarter, or year. Here's how to close inventory effectively. 1. Final count. Conduct a thorough physical count of all items in stock to determine the ending inventory levels accurately. 2. Adjustments. Make any necessary adjustments for damaged, lost, or obsolete items discovered during the final count. 3. Valuation. Determine the valuation method for closing inventory, e.g., FIFO, LIFO, weighted average, based on accounting standards and company policies. 4. Calculate cost of goods sold, COGS. Calculate the cost of goods sold during the accounting period using the inventory valuation method chosen. 5. Update records. Update inventory records to reflect the final inventory levels and any adjustments made. 6. Financial reporting. Use the closing inventory and COGS figures to prepare financial statements, such as the income statement and balance sheet. 7. Review and reconcile. Review the closing inventory balances against previous periods and reconcile any discrepancies. 8. Audit. Conduct internal or external audits to ensure accuracy and compliance with accounting standards and regulations. Closing inventory accurately is crucial for financial reporting, tax purposes, and decision-making. Regular reconciliation and audits help maintain the integrity of inventory records. Who has to take inventory? Inventory taking is typically the responsibility of individuals or teams within a business who are designated to manage inventory control and management. This often includes 1. Inventory managers. They oversee the entire inventory management process, including planning, organizing, and executing inventory counts. 2. Inventory clerks. They are responsible for physically counting and recording inventory levels accurately. 3. Warehouse staff. Individuals working in the warehouse or storage areas are often involved in the physical counting of inventory. 4. Retail staff. In retail environments, employees may participate in inventory counts, especially during scheduled stock-taking sessions. 5. Accounting or finance team. They use the inventory count data for financial reporting and analysis, including calculating the cost of goods sold and valuing inventory for balance sheet purposes. Ultimately, the responsibility for taking inventory falls on those who have been assigned roles related to inventory management within the organization. How to address an inventory shortage? Addressing inventory shortages effectively involves several steps. 1. Identify the cause. Determine the root cause of the inventory shortage. It could be due to inaccurate forecasting, stockouts from suppliers, theft, or operational inefficiencies. 2. Review inventory processes. Evaluate inventory management processes, including ordering, receiving, storage, and tracking, to identify weaknesses or areas for improvement. 3. Implement tighter controls. Strengthen inventory control measures, such as implementing stricter access controls, conducting more frequent audits, and improving security measures to prevent theft or shrinkage. 4. Optimize reordering. Review and adjust reorder points, lead times, and order quantities based on more accurate demand forecasts and historical sales data to avoid future shortages. 5. Diversify suppliers. Reduce reliance on a single supplier by diversifying your supplier base or establishing backup suppliers to mitigate the risk of stockouts. 6. Emergency ordering. Establish protocols for emergency ordering or expedited shipping options to quickly replenish inventory in case of unexpected shortages. 7. Train staff. Provide training to staff involved in inventory management to ensure they understand proper procedures for receiving, handling, and tracking inventory accurately. 8. Invest in technology. Consider investing in inventory management software or systems that offer real-time tracking, automated replenishment, and advanced analytics to improve inventory visibility and control. 9. Collaborate with suppliers. Work closely with suppliers to improve communication and coordination, optimize order fulfillment processes, and address any issues that may lead to shortages. 10. Continuous improvement. Continuously monitor and review inventory performance metrics, solicit feedback from staff, and implement continuous improvement initiatives to address inventory shortages proactively. What are all the techniques to be followed to maintain minimal inventory? Maintaining minimal inventory levels while still meeting customer demand requires efficient inventory management techniques. Here are several strategies to achieve this. 1. Just-in-time (JIT) inventory. Adopt a just-in-time inventory approach to minimize stock on hand by receiving goods only when they are needed for production or to fulfill customer orders. 2. Lean inventory management. Implement lean principles such as reducing waste, optimizing processes, and improving efficiency to minimize excess inventory. 3. ABC analysis. Classify inventory items into categories based on their importance and value. Focus on managing high-value items more closely while reducing stock levels of lower-value items. 4. Forecasting and demand planning. Use historical sales data, market trends, and demand forecasting techniques to predict future demand accurately. This helps in ordering the right amount of inventory to avoid excess stock. 5. Safety stock optimization. Determine optimal safety stock levels to account for variability in demand, lead times, and supply chain disruptions while minimizing excess inventory. 6. Supplier collaboration. Collaborate closely with suppliers to establish reliable delivery schedules, reduce lead times, and ensure timely replenishment of inventory to minimize the need for excess stock. 7. Ordering policies. Implement efficient ordering policies such as economic order quantity (EOQ) and reorder point (ROP) to optimize order quantities and minimize holding costs. 8. Inventory visibility. Improve visibility into inventory levels across the supply chain using inventory management software, RFID tracking, or barcode systems to make informed decisions and prevent overstocking. 9. Just-in-case (JIT) inventory. Evaluate the necessity of safety stock and excess inventory levels, and eliminate any unnecessary buffer stock that is not justified by actual demand variability. 10. Continuous improvement. Continuously monitor inventory performance metrics, identify opportunities for improvement, and implement corrective actions to optimize inventory levels and processes over time. By implementing these techniques and continuously monitoring and adjusting inventory management practices, businesses can maintain minimal inventory levels while still meeting customer demand and ensuring operational efficiency. Effect of over-inventory. Over-inventory, or excess inventory, can have several negative effects on a business. 1. Increased holding costs. Excess inventory ties up capital in stock that is not immediately needed, leading to higher holding costs such as storage, insurance, and depreciation. 2. Reduced cash flow. Excessive inventory ties up cash that could be invested elsewhere in the business, potentially limiting growth opportunities and hindering cash flow. 3. Risk of obsolescence. Over time, excess inventory may become obsolete or perishable, resulting in write-offs or markdowns to liquidate the inventory at reduced prices. 4. Increased risk of damage or theft. Large quantities of inventory increase the risk of damage, theft, or loss, leading to additional costs and potential disruptions to operations. 5. Higher carrying costs. Excess inventory requires more warehouse space and resources to manage, leading to higher carrying costs and potentially inefficient use of space. 6. Decreased profit margins. Excess inventory may lead to markdowns or discounts to clear the excess stock, reducing profit margins and eroding profitability. 7. Decreased agility. Having too much inventory can make it difficult for businesses to respond quickly to changes in demand, market trends, or supply chain disruptions. 8. Quality issues. Large quantities of inventory may lead to quality issues if products are stored for extended periods, resulting in deterioration or damage. 9. Opportunity cost. The capital tied up in excess inventory could be used for other strategic investments or opportunities, representing a missed opportunity cost for the business. 10. Strained supplier relationships. Over-ordering can strain relationships with suppliers if the business consistently fails to accurately forecast demand, leading to issues such as stockouts or excess inventory returns. Overall, excess inventory can strain financial resources, hinder operational efficiency, and reduce profitability, highlighting the importance of effective inventory management to optimize inventory levels and minimize waste. What is dead inventory? Dead inventory, also known as obsolete inventory or dead stock, refers to products or items that are no longer sellable or usable due to various reasons. 1. Outdated products. Items that are no longer in demand or relevant to current market trends become dead inventory. 2. Expired goods. Perishable items, such as food, cosmetics, or pharmaceuticals, that have reached their expiration date and cannot be sold. 3. Damaged or defective items. Products that are damaged, defective, or otherwise unsuitable for sale due to manufacturing defects, transportation damage, or mishandling. 4. Seasonal items. Seasonal products that were not sold during their intended selling season become dead inventory until the next season, if applicable. 5. Discontinued items. Items that have been discontinued by the manufacturer or are no longer part of the business's product line. 6. Overstocked items. Items that were purchased in excess and have exceeded their shelf life or demand, leading to accumulation and stagnation. 7. Technological changes. Products rendered obsolete by advancements in technology, such as outdated electronic devices or software. Dead inventory ties up valuable warehouse space, ties up capital, and incurs holding costs without generating revenue. Effective inventory management practices, such as regular inventory audits, accurate demand forecasting, and proactive markdown strategies, can help businesses minimize dead inventory and optimize their inventory turnover ratios. Effect of dead inventory. The presence of dead inventory can have several negative effects on a business. 1. Financial losses. Dead inventory represents capital tied up in unsellable goods, leading to financial losses due to the inability to generate revenue from those products. 2. Increased holding costs. Dead inventory incurs holding costs such as storage space, insurance, and depreciation, further contributing to financial losses. 3. Reduced cash flow. Capital tied up in dead inventory is unavailable for other business activities, potentially limiting cash flow and hindering investment in growth opportunities. 4. Wasted resources. Dead inventory consumes valuable warehouse space and resources that could be used for more productive purposes, leading to inefficiencies and increased operational costs. 5. Decreased profitability. The presence of dead inventory can negatively impact profitability by reducing overall sales margins and eroding profit margins due to the inability to recover costs associated with the unsellable goods. 6. Obsolescence risk. Dead inventory may become obsolete over time, further reducing its value and increasing the likelihood of write-offs or markdowns to liquidate the inventory. 7. Inventory management challenges. Managing dead inventory requires additional time and effort to identify, track, and dispose of unsellable goods, diverting resources away from more productive tasks. 8. Strained supplier relationships. Accumulating dead inventory can strain relationships with suppliers if the business consistently overorders or fails to accurately forecast demand, leading to excess inventory returns or strained negotiations. 9. Reputation damage. In extreme cases, the presence of dead inventory may reflect poorly on the business's reputation, signaling inefficiencies in inventory management and potentially affecting customer trust and loyalty. Overall, dead inventory represents a significant challenge for businesses, highlighting the importance of effective inventory management practices to minimize obsolescence and optimize inventory turnover ratios. How to avoid dead inventory? To avoid dead inventory and minimize the negative impact on your business, consider implementing the following strategies. 1. Accurate demand forecasting. Use historical sales data, market trends, and demand forecasting techniques to predict future demand accurately. This helps in ordering the right quantity of inventory to avoid overstocking. 2. Regular inventory audits. Conduct regular inventory audits to identify slow-moving or obsolete items early on. This allows you to take proactive measures to address them before they become dead inventory. 3. Dynamic pricing and promotions. Implement dynamic pricing strategies and promotions to stimulate demand for slow-moving inventory and prevent it from becoming dead stock. Offer discounts, bundle deals, or special promotions to encourage sales. 4. Optimize inventory mix. Continuously review and optimize your product mix to focus on items with higher demand and profitability. Consider discontinuing or reducing orders for items that consistently underperform or have limited market demand. 5. Supplier collaboration. Work closely with suppliers to adjust order quantities, delivery schedules, and inventory levels based on changing market conditions and demand forecasts. Establish open communication channels to address any issues promptly. 6. Just-in-time inventory management. Adopt just-in-time inventory practices to minimize stock on hand and reduce the risk of overstocking. Receive goods only when they are needed for production or to fulfill customer orders. 7. Monitor shelf life and expiry dates. Regularly monitor the shelf life and expiry dates of perishable goods and implement strategies to sell or dispose of them before they expire. 8. Implement return policies. Offer flexible return policies for slow-moving or obsolete inventory to encourage customers to return unsold items. This allows you to restock or liquidate the inventory more effectively. 9. Liquidation or disposal. Develop strategies for liquidating or disposing of dead inventory efficiently. This may include selling through clearance sales, discount outlets, online marketplaces, or donating to charity. 10. Continuous improvement. Continuously monitor inventory performance metrics, solicit feedback from staff, and implement continuous improvement initiatives to optimize inventory management practices and minimize the risk of dead inventory in the future. By implementing these strategies and maintaining a proactive approach to inventory management, businesses can minimize the risk of dead inventory and optimize their inventory turnover ratios. How to handle dead inventory? Handling dead inventory effectively is crucial to minimize its negative impact on your business. Here are several steps you can take to manage dead inventory. 1. Identify dead inventory. Conduct a thorough inventory analysis to identify items that are considered dead inventory. This may include products that have been sitting on shelves for an extended period, are damaged, obsolete, or have expired. 2. Assess value and condition. Evaluate the value and condition of dead inventory to determine the best course of action. Consider factors such as salvage value, potential for liquidation, and disposal costs. 3. Liquidation. Explore opportunities to liquidate dead inventory through clearance sales, discount outlets, online marketplaces, or liquidation wholesalers. Offer attractive discounts or bundle deals to incentivize customers to purchase the inventory. 4. Donations. Consider donating dead inventory to charitable organizations or non-profit groups. Donating excess inventory not only helps those in need but also provides a tax deduction for your business. 5. Recycling. If possible, explore recycling options for dead inventory, especially for items that cannot be sold or donated. This helps minimize environmental impact and may also provide cost savings in disposal fees. 6. Repurposing or upcycling. Explore opportunities to repurpose or upcycle dead inventory into new products or materials. This can help reduce waste and create value from otherwise unusable inventory. 7. Return to supplier. Contact the supplier or manufacturer to inquire about return or exchange options for dead inventory. Some suppliers may accept returns or offer credit for unused or unsellable inventory. 8. Write-offs. If dead inventory cannot be sold, donated, recycled, or returned, consider writing it off as a loss on your financial statements. Consult with your accountant or financial advisor to ensure compliance with accounting standards. 9. Learn and adjust. Analyze the root causes of dead inventory and take steps to prevent similar situations in the future. Adjust inventory management practices, demand forecasting techniques, and purchasing strategies to minimize the risk of accumulating dead inventory. 10. Continuous monitoring. Implement processes to regularly monitor inventory levels and identify potential dead inventory early on. Conduct regular inventory audits and review performance metrics to proactively manage inventory and avoid future dead stock situations. By effectively handling dead inventory and implementing proactive inventory management practices, businesses can minimize losses, optimize inventory turnover, and improve overall profitability. Who is responsible for dead inventory? Responsibility for dead inventory typically falls on multiple stakeholders within a business, including 1. Inventory managers. Those responsible for overseeing inventory management processes are often accountable for identifying and addressing dead inventory issues. They play a key role in implementing strategies to prevent or minimize the accumulation of dead stock. 2. Purchasing and procurement teams. Teams involved in purchasing and procurement are responsible for ordering inventory and managing supplier relationships. They play a crucial role in ensuring that inventory levels are optimized and that excess inventory is not ordered unnecessarily. 3. Sales and marketing teams. While not directly responsible for inventory management, sales and marketing teams can influence demand forecasting and inventory levels by providing insights into market trends, customer preferences, and promotional strategies. 4. Finance and accounting departments. Finance and accounting departments are responsible for tracking inventory value, assessing the financial impact of dead inventory, and making necessary adjustments to financial statements. 5. Warehouse and operations staff. Staff responsible for warehouse operations play a role in identifying and managing dead inventory on a day-to-day basis. They may be involved in conducting inventory audits, managing storage space, and implementing inventory control measures. 6. Senior management and executives. Ultimately, senior management and executives are accountable for overseeing the overall performance of the business, including inventory management. They set policies, allocate resources, and provide direction to ensure that dead inventory is effectively managed and minimized. While specific responsibilities may vary depending on the organizational structure and processes, addressing dead inventory typically requires collaboration and coordination among multiple departments and stakeholders within the business. What is just-in-time? Just-in-time (JIT) is a production and inventory management approach aimed at minimizing waste and improving efficiency by producing or delivering goods and services just in time to meet customer demand. In a JIT system, inventory is kept to a minimum, and items are only produced or acquired when they are needed, in the quantities required, and at the right time. Key principles of JIT include 1. Pull system. Production is driven by actual customer demand rather than forecasts or speculative stockpiling. Orders are pulled through the production processes needed. 2. Reduced inventory. Inventory levels are kept low, which helps reduce holding costs, minimize storage space requirements, and avoid obsolescence or spoilage. 3. Continuous improvement. JIT encourages continuous improvement in processes, quality, and efficiency to eliminate waste, improve productivity, and enhance overall performance. 4. Supplier relationships. Strong relationships with suppliers are essential to ensure timely delivery of materials and components in line with production schedules. Suppliers are often located close to the production facility to minimize lead times and transportation costs. 5. Flexible production. JIT systems prioritize flexibility and adaptability to quickly respond to changes in customer demand, production requirements, or market conditions. 6. Quality focus. Emphasis is placed on maintaining high-quality standards throughout the production process to minimize defects, rework, and waste. 7. Employee involvement. JIT encourages employee involvement and empowerment to identify opportunities for improvement, suggest solutions, and implement changes to streamline processes and reduce waste. JIT is widely used in manufacturing industries such as automotive, electronics, and aerospace, but its principles can also be applied to other sectors, including services and healthcare. While JIT offers many benefits, such as improved efficiency and reduced costs, it also requires careful planning, coordination, and risk management to ensure reliable supply chains and uninterrupted production. What is Kanban? Kanban is a visual scheduling system used in manufacturing, project management, and other areas to manage workflow, optimize processes, and improve efficiency. Originating from Toyota's production system, Kanban emphasizes just-in-time, JIT, production and lean principles. The core elements of a Kanban system include 1. Visual boards, physical or digital boards that visually represent the workflow, with columns representing different stages of the process, from to do to done. 2. Kanban cards, cards or visual signals that represent individual tasks, items, or work units. Each card contains relevant information such as task details, priority, and status. 3. Work in progress, WIP, limits, constraints placed on the number of tasks or items allowed in each stage of the workflow to prevent overloading and maintain flow. 4. Pull system asterisk, work is pulled through the process based on demand, with new tasks initiated only when there is capacity to handle them. 5. Continuous improvement. Kanban encourages continuous improvement by enabling teams to visualize bottlenecks, identify inefficiencies, and implement changes to improve workflow and productivity. Kanban offers several benefits, including visual management, provides a clear, visual representation of workflow, making it easy to track progress, identify bottlenecks, and prioritize work. Flexibility allows teams to adapt quickly to changing priorities and workload by dynamically adjusting task priorities and allocation. Reduced waste helps minimize waste by optimizing workflow, reducing inventory, and eliminating unnecessary tasks or delays. Increased efficiency improves efficiency by streamlining processes, reducing cycle times, and maximizing resource utilization. Kanban is widely used in software development, manufacturing, project management, and various other industries to streamline operations, improve collaboration, and drive continuous improvement. What is WIP? WIP stands for Work in Progress, referring to tasks, projects, or items that have been started but are not yet completed. In the context of project management, manufacturing, or any workflow-based process, WIP represents the portion of work that is actively being worked on or moved through various stages of completion. Key characteristics of WIP include 1. Active status. WIP items are actively being worked on by individuals or teams and are in various stages of completion within the workflow. 2. Temporary state. WIP items are in a transient state between being initiated and completed. They are not yet finished but are progressing toward completion. 3. Limitation. WIP is often subject to limits or constraints to prevent overloading and maintain flow within the system. These limits, known as work in progress limits, WIP limits, help prevent bottlenecks and ensure that resources are utilized effectively. In project management, WIP can include tasks, deliverables, or milestones that are in progress but not yet completed. In manufacturing, WIP refers to partially completed products or components that are being processed through different stages of production. Monitoring and managing WIP is crucial for maintaining productivity, identifying bottlenecks, and optimizing workflow efficiency. By controlling WIP levels and ensuring that tasks or items move smoothly through the workflow, organizations can improve throughput, reduce lead times, and enhance overall performance. What is buffer stock? Buffer stock, also known as safety stock or buffer inventory, refers to the surplus inventory held by a company to protect against fluctuations in demand, supply chain disruptions, or variability in lead times. Buffer stock acts as a cushion to ensure that sufficient inventory is available to meet customer demand even during unforeseen circumstances. Key characteristics of buffer stock include 1. Insurance against uncertainty. Buffer stock serves as a form of insurance against uncertainties such as fluctuating demand, unexpected spikes in orders, or delays in supply chain deliveries. 2. Redundancy. Buffer stock is considered redundant inventory that is held beyond what is immediately needed to fulfill customer orders. It provides a safety net to prevent stockouts and ensure continuity of operations. 3. Cost of carrying. Holding buffer stock incurs costs such as storage, insurance, and opportunity costs associated with tying up capital in inventory. However, these costs are justified by the benefits of having a reliable supply of inventory to meet customer demand. 4. Variable levels. The level of buffer stock maintained by a company may vary depending on factors such as demand volatility, lead times, supplier reliability, and service level targets. Buffer stock is commonly used in inventory management strategies such as just-in-time, JIT, and Kanban to mitigate the risks associated with uncertainty in demand and supply. By strategically managing buffer stock levels and aligning them with business objectives and risk tolerance, companies can ensure a balance between service levels, inventory costs, and operational efficiency. Brought to you by YouTube channel, Manufacturing Excellence. Created by Gnanasekharan Vediyappan.